One of the main features of having a Canadian-controlled private corporation is what we call the capital gain exemption. And of course, this is to encourage small businesses to start up, new businesses and everything else, to encourage entrepreneurs basically to build a business, hire people, things of that nature there. So they give you some tax breaks, basically. But remember that it only applies to Canadian-controlled private corporations, so the CCPC, basically. That's what it's all about, okay? And it really kicks in, this particular section, basically capital gain exemption, kicks in upon disposition of the shares. And that could be when the person sells the company itself or when the person dies. It doesn't really matter. There is a disposition of the shares. Okay, so upon disposition of the shares, that person who is a shareholder of Canadian-controlled private corporation may be eligible for lifetime capital gain exemption of $800,000 plus. Now, why the plus is because it started off at $800,000, but it's indexed. So it keeps on going year by year. So you'll see the 2017 numbers in a moment. So basically what we're saying is that there is a lifetime capital gain exemption for a person who owns shares in a Canadian-controlled private corporation, but it is indexed. So it's designed basically to offset the capital gain taxes, okay, tax on capital gain on shares that a person may have in a Canadian-controlled private corporation, on a family farm, or family fishing. So the idea, again, is to encourage people to build companies, and you might say hand them down, you might say for the next generation and everything else, and be able to pull out a substantial amount of money from your company, essentially on a tax-free basis. So we have an example here. You see what I'm driving at. So Bill's a shareholder of whatever company that he may own. He owns a company, essentially, and Bill dies. Like I said, it could be while he's alive as well. It doesn't really matter. But let's assume he's dead. At the time of death, the fair market value of the shares were $2,400,000. That's what they were assessed at. When you originally started the company, you probably threw in $200,000 of capital sitting in there. So his adjusted cost base is $200,000. And remember, the adjusted cost base is always tax-free. It is what did it cost me to start the business. So in this case here, it cost him $200,000. So therefore, the capital gain is $2,200,000. So that's where he's got a tax issue. And if it wasn't a Canadian-controlled private corporation, the $2,200,000 with 50% of it would be tax-free, the other 50% would be taxable. So it would be quite considerable amount of tax liability. However, because it is a Canadian-controlled private corporation, and therefore it does qualify for the lifetime capital gain exemption. So assuming the lifetime capital gain exemption for 2017 was $835,716. Like I said, this is indexed, so it changes every year. So for last year, in 2017, it was $835,716. So that basically means that the first $835,000 is tax-free. No 50%, no nothing. It's just simply tax-free. $835,000 comes out. So from the $2,200,000 of capital gain, basically, he's got $835,000 of capital of lifetime capital gain exemption that doesn't have to pay anything. So really, the only taxable capital gain he's got is $1,364,284 would be the taxable capital gain. If that hadn't been there, as I said, it would be $2,200,000, so it would be quite substantial. Okay, so you can see the tax saving that's involved here. Okay, so from that, basically, now that he's got that money sort of out of there, he's got $1,364,284 basically in taxable capital gain. But remember that that excess amount of money is inclusion rate of 50%. The other 50% is taxable, the other 50% is not taxable. Okay, so basically 50% of $1,364,284 is $682,142 is the only portion. So out of the $2.4 million, only $682,142 is actually taxable, you might say. He builds in a 45% marginal tax rate, let's say, so it's 45% of $682,000, okay, comes out to $306,964. So when you look at all this, he comes out basically with $2,200,000 we're getting to say CB, but let's say $2.4 million. But out of that entire $2.4 million, he only has to pay tax of $306,000. The rest of it goes right into his pocket, totally tax-free. So you can see the importance here of the capital gain exemption for the, but like I said, it has to be Canadian-controlled private corporation. It cannot be a public corporation, and it can also not be a private corporation, but owned by foreigners. In other words, 51% has to be Canadian residents in order for this to qualify. Otherwise, it will not qualify. So this is an important consideration when you're looking at when you're dealing with your clients who are private corporations. Some of them may not be aware of the tax implications that are involved here by having this rather large lifetime capital gain exemption. And remember that is indexed. So for 2017, it was $835,000. And then, of course, every year it goes up according to inflation and everything else. So when you do your calculation, you need to know what that particular year's exemption is. And then you can tell your client, Mr. Jones, this much money can come out of your company totally tax-free. The rest of it, of course, will be subject to the inclusion rate, and then, of course, times your marginal tax rate for tax purposes. Okay.